I've done a number of these at the bar sessions. They're on Kitco and scattered other places as well.
Of course you have done a number of these at the bar sessions.
And you invited me. I made the mistake of inviting Peter. And what I'm trying to do here is bring together some of the best people in the industry in a relaxed atmosphere. And the objective here is to sort of give you insights into how successful people in this industry think about projects, mines, the markets, and why they're successful. The sort of things that you're not likely to get other places. So what I want to do is just start with a few questions, and then we'll open it up to the audience, and I'll throw some out there as well. So think of questions you come up with. And we're lucky. What we've got here is a real mix of people, starting with Scott Trebilcock.
You got to say the cock part, don't worry.
Yeah. I was embarrassed.
This is going to be good.
Scott's with a company that actually found a deposit, brought it into production in a very tough location. It's a very successful, in my opinion, probably the most undervalued company at this show. And just recently acquired another project in Serbia held by Reservoir. So that's his experience. Eira Thomas, I think you all know a lot about Eira, but most recently came on as the CEO of Camac and really brought a discovery all the way through to a production, a feasibility study, and then was bought out by Goldcorp. Peter, on the other hand, is a really, really good exploration geologist. He's worked all over the world, and I got a lot of respect for what he does. And so he brings in the very early stage grassroots stuff. And myself, they put me up here because I'm pretty used to bullshitting from the bar, really. And I feel comfortable here. So what I want to do is start with the big picture and work on down. And I'll start with Eira. And the question I've got, and I think it's useful, is with regards to the Goldcorp acquisition of Camac, what was it that you did from when you came on? I mean, how were you thinking in terms of what was it that a company was going to need to see in order to, buy you out? What things was it that ticked off the boxes for Goldcorp that you did right?
Okay, well, that's a great question. Can everybody hear me?
Let's try that.
Can you hear me? Is that better? First of all, we weren't actually for sale, and I think that's important to set out right at the beginning, because I think, our strategy was very focused on de-risking what we thought was one of the best undeveloped gold projects in the world, taking it through feasibility at a tough time in the market, and really designing that study to give our board the right information to make a decision on whether to take this project forward. So when we did that, we learned that we had a very economic project, and a project that we in fact could do ourselves. So, Camac has always been our approach to signing CAs with corporates has been very defensive. Our view was that if we were to get an unsolicited offer, we want to make sure that we had some friends in the tent, so to speak, that potentially could be there to help us in a defensive situation. And so we were very selective on who we signed CAs with. We only signed CAs with corporations that we thought could really add value to this project. So I think the fact that we didn't put ourselves up for sale, we really approached the corporate alliance more defensively, and we said all the way along that our plan was to get this thing to the finish line. Should a compelling offer come along that was something that we just had to look at and that our shareholders would want us to look at, of course we would do that, and that's exactly what happened with Goldcorp. So they put a compelling offer on the table that really gave us a pause, and it allowed our shareholders to lock in value today and really de-risked the next phase, which is the 3 years of construction and development that we would have to go through in order to see first gold, late in 2019.
Let's go back further. What was it? I mean, you could have gone anywhere you wanted. You picked, come on board, you're a diamond the Diamond Girl. You picked to come on to Kaminak, a gold project. What was it about Kaminak that made you come in there?
First and foremost, it always comes down to the geology, and obviously it was very compelling geologically, but the other really important thing, and Brent, you've talked about this a lot, and certainly Joe talked about it in his speech today. This project had great stewardship right from the beginning. The former CEO, Rob Carpenter, is a PhD geologist who understands structurally hosted gold deposits. The quality of the work that had been done at Kaminak was very high. So I felt very comfortable because of the people that were involved in the project from day one, reviewing that information and being confident in that information, and that gave me a lot of comfort in making a decision to get involved. There was still a lot we had to understand about this deposit. My job and mandate coming in was taking a really exciting discovery and trying to figure out whether or not it was going to be economic. So I think the people, the quality of the technical work, obviously the deposit itself, and the fact that it had the earmarks of a world-class gold deposit were all factors. And I think you have to put those all together, and it equates to the quality message that you were speaking to over the last 2 days.
Excellent. Okay, let's jump over to Scott. You've been with Nevsun for I'm not sure how long. A long time. Nevsun, is a single asset company, and for many years, you guys were sitting on maybe $400 million in the bank, and every meeting you went to, as far as like, what are you going to buy next? What was it? What was your criteria? I mean, what did you have to see in order to make that acquisition? What was it that you needed to see in a property to trigger it?
Yeah, well, I think in the end,
Can you hear him okay?
I think in the end it came down really to a fundamental property of the rocks, right? It's about, and ultimately, no matter which way we spin the metrics, we call it return, it really came down to grade. We spent the better part of 4 years doing diligence on a wide variety of assets in the gold space, in the base metal space, and you always start at the rocks. And we got close on things that were lower grade, that had good return metrics because of infrastructure, because of other characteristics, and we just couldn't get there on return. We're a dividend payer, and we look at assets from a risk perspective because we're an operator, right? We're not trying to find the way to get it into operation the cheapest way. We're not undercapitalized, so we need to find ways to maybe maximize the doability of the asset. It was about taking an approach that's risk balanced. So we come up with a business case that we think is right down the middle. We think there's a balance of opportunity to make the asset better, and a balance of risk where things are going to go wrong, costs are going to go up, as opposed to what we typically see when we go into a due diligence, and it's just the nature of being, in a developing company, is their tendency is to go right on the non-conservative side of the numbers. As an operator, we have to go straight down the middle to make sure we can generate a return before we pull the trigger.
Was there an IRR target you sort of had?
Not one specific target. There was a minimum.
What's the minimum?
That we thought, it depends on the country. So, right? Like,
No,
I
that's good-
don't
good
think
point,
we
good
I don't think
point.
we would have invested $1 under 10%. That's if we bought like a great producing asset, right? With the right risk profile, your cost of capital says you have to meet that hurdle. And most assets just don't have the risk profile that we had access to, and our number would go up from there.
All right, cool. All right, so far I'm liking this. We've heard rocks. We've got a geologist here. Given what what you've heard, your work. Entertainment, yeah. Given what we've heard, you're working up in the Yukon. You've worked all over the place. What is it that when you go out to an actual property, how do you decide whether it's worth even spending any time on? What are your criteria in an early stage exploration?
Well, in this case, it was grade, because all the veins that I looked at ran an ounce. There are two now that run 1,000 grams, so that's 30 to 50 ounces. They're tiny, they're tiny, but they have potential. And there are so many veins, all with mineralization, visible gold, clots of gold. So basically it's grade, and as you know, grade disguises many sins if you can find enough of it. And so I thought, because I already knew the longer term history of the project, which it was totally unexplored, although that's hard to explain to the market. And all it needed was a rethink of what had already been done, or what hadn't been done in this case. And went, wow, I mean, there's a model there that fits. You know, I can see 1 million ounces, I can see 10 million ounces. I can see more, in fact. And all I have to do is go and explore, and for a very limited amount of money, and it's probably 2 million, 3 million, 5 million bucks, I can come out of it with a clear target and path to 1 million ounces or multi-million ounces. So risk-reward is so skewed that it was a no-brainer.
One of the things I've always had a problem with in this industry, in the exploration side, is that, can you all hear me, or is it just too loud? Is that too many geologists don't really have a handle on what they need in terms of economics, you know, the deposit to break some sort of hurdle. I mean, you're near a road, so your hurdle is much lower, but still, you've got to have a hurdle that says, I need, conceptually, I don't know, 1 million ounces at 3 grams or 5 grams, depending on if it's open pit underground. Do you walk around to that in your head?
Always. I mean, I look at it, and it has to have strike potential, it has to have depth potential. But actually, the way we're exploring and doing exploration drilling, the pattern is designed I'm targeting an outcrop. It has visible gold, and it has X, like a meter or 30 centimeters, whatever. We drill 2 holes underneath it, one at a 45, one at an 85, and hit it twice from the same setup. And if we see that in core, we move 50 meters over and do the same thing. And by the time we exit the showing, and consider this to be Timmins 100 years ago, by the time I exit the showing, we have potentially 4 intercepts. If they run, I've gone from a discovery to something that is estimatable as a resource, because these are close enough together to make it an inferred resource.
Sorry, I didn't want to interrupt there, but I think the question was a really relevant one, because of talking about how you go from early stage exploration and making a decision on what you do next. And, you know, when I joined Camac, there was no doubt that we could continue to move the drill along these prolific structures that were identified by gold and soil anomalies, and we would continue to hit gold. But fundamentally, we hadn't answered yet the question whether or not any of that gold could be pulled out of the ground economically. And so the key risks for us in year 5 of our exploration strategy was strip ratio and metallurgy. And without tackling those, we really weren't messaging what the opportunity would look like. And that became a critical thing, and being able to take those discoveries then and actually turn them into something. And, you know, Brent, you asked, you know, do you have it in mind, your own mind, what you need in terms of grade or tonnage? Well, sure, but there's so many variables that are going to impact the economics. You know, sometimes you got to get that resource drilled off to the point where you've got obviously enough ounces to even consider it, and then you got to go the next stage.
Yeah. But so, and my point is, I'm at the grassroots twigs and berries stage, and what I have to demonstrate, it's not really for me even, it's to the market and to people. To get next year's budget, I have to show the potential of something this year now. And if it doesn't work, quite frankly, I'm not one of these geologists that likes to do this as a job for life. If the target doesn't pay, and it's not there, then okay, move on, forget it. And if the whole project doesn't look like it's going to go, then it's time to stop, because don't waste shareholders' money or anybody's money on doing it.
I think that's a real important point. Too many companies waste too much time on projects once they're past the stage where they're really not of any value. So let's move on to Kaminak. Eira,
Okay.
who actually made money on Kaminak? Who were the investors that really did it right and really made a big score on this?
Well,
You can give names.
there were definitely two waves of investors in Camac that made money. The first wave was, in the last cycle, when things were moving forward with the underworld discovery, and it was a momentum play. At that point, Camac really didn't know what they had. They had some interesting looking anomalies and a discovery or two under their belt, and that was it. So lots of people made money in that wave. The tougher wave, was post 2011 and, post the first resource at Kaminak. And that was a real challenge for us, quite frankly, because we went into this down cycle without a lot of sponsorship on the shareholder side. A lot of people had made a lot of money and hopefully and thankfully exited and took some profit off the table, and we think that's great. But what we were left with was a huge retail shareholder base. We didn't have a lot of institutions, and we really didn't have a lot of insider ownership in the company either. So what was critical for us was securing some strong shareholders. Lucas Lundin, Ross Beatty, they were early in on the story, as was Jamie Horvat and M&G, or Vanguard Investments out of London. Jamie was actually the first with a very small toehold investment of 3%. Ross and Lucas then came in at just under 10% each, and then the three of them continued to finance us until the last financing we did brought in our fourth strategic shareholder, and that was Electrum. So we were in a situation where we had almost 45% of the stock held in strong, supportive hands that were willing to write checks at a tough time in the market when there wasn't a lot of cash being raised. And we were able to do that in private placements, relatively non-dilutive, either non-warrant deals or half-warrant deals, and that was actually really important for Kaminak, and I think that we couldn't have created the value we created today without that sponsorship.
All right, excellent. I guess that's, we're here to make money, and I thought what I want to do is throw that question out to some successful people in the audience as well, who may not be geologists or mining engineers, but do really well. And I guess I'm just going to ask a question and come out here. I'll start with Mr. Lotan. Dave, what do you think it is that, what is your selection criteria, and what works for you, and what would help people out here?
Well, with the venture at 470, I'd say my selection criteria was throw a dart.
Wrong answer.
And with the venture at 670, it's throw a dart, and if it doesn't land on Mirasol, buy Mirasol. But I'm kidding. I bought Kaminak very, very early on, before Eira came on board. It was a stock that was recommended by you and Paul. And it got orphaned. It had a real rough go in the crisis of '08. Went down to 8 cents. But it had a good structure. It had money in the bank. They actually authorized a share buyback, which was amazing. They hadn't spun out Kivalliq yet, but you're talking about a 40 million share structure with good guys who'd been successful in the past. And the very, very first criteria that makes a stock go up is when there are more dollars buying it than there are dollars selling it. And nothing creates that condition like a good structure. And then if you layer on top of that great management and a great project, you can have a really inspired price response for any success. And you saw that with Reservoir when they had those hits. It was maybe a 30 million share float. Saw it with Lara in the last couple of weeks, because everyone thinks Miles Thompson will do it again. It's got a 31 million share float. So Rob started with a great float. He took it as far as he could. And then Rich Hall told me, we needed a mine builder, so we hired Eira. And I think that it was a great early playbook and a great late playbook.
All right, thanks, Dave. I'm gonna jump over to your mate right there, who's not expecting this, Brad Hemmingson. You're a broker. How important is structure, and more importantly, what can you tell us that's going to help us understand how the brokerage industry works and how to actually make money in this? What do you do?
Well, I've known you for a long time. To me, it's always been about structure. Rick Rule's not here today, so I can maybe say a few disparaging comments about Rick, who's a dear friend of mine. Every deal doesn't have to need to be done at 5 cents with a 5-year warrant at 6 cents. Because what we're seeing is those warrants are crippling. And a lot of really good projects great investors at the institutional side. It's like, I've known Eira a long time. I don't know her super well, but she's a really smart girl. And if she were to look at a deal that had 30 million shares out and 35 million warrants, a penny higher than the bid, she'd probably say, that's a really difficult thing for me to do.
Yeah.
And it's...
Smart person, Brad.
Oh, sorry.
Person.
I don't mind.
Smart person. I just identified myself as a dinosaur. I'm sorry, Eira.
I like being a girl. That makes me feel good.
Woman, anyway. But no, I mean, let's be serious, is that at the end of the day, you take an asset, you divide it by the number of shares outstanding, fully diluted. It's a lot of things that Rick says is people, property, location, jurisdiction. And once all those things do, you have to have a structure that makes it work, and you have to make it financeable, because in bad markets, what happens is you have a great company with a great drill hole that can't get the stock to move up 1 cent to get a financing at a higher multiple, and that screws everything for everybody.
That's really important information. I love it. And only the people listening got that. Those folks don't understand it.
They're having free wine, they don't care.
Okay.
Oh, I like that. No, I totally agree. That's, yeah.
Yeah.
So, again, I've been doing this for 28 years. Your universe gets smaller because what you want to do is you want to do business with people you like, people you trust, people that you don't have to keep checking in on to make sure they're not wasting the treasury, that they're not blowing 80-90% of the treasury annually on G&A. And the other thing is that every single person here has access to CDAR. You can go online, you can read the quarterlies, you can see who's stealing the money, you can see where they're wasting it, and you can say, look, $1 million went in, they didn't drill a goddamn hole, there's no money left.
Sometimes.
Oh, yeah.
Figure it out, people, it's not that hard. So, there you go, there's my rant.
Excellent. I'm gonna throw it now. We're gonna talk about the brokers and bankers and such, and I'm gonna throw that over to Joe. So just give him the mic. But all right, it's on. You've come across from the sell side. What should we know as retail investors about bank research? What is it that educate us? How it works, why it works, and what's really going on, and why you're working with Exploration Insights now.
Well, I've got a lot of respect for a lot of the sell-side analysts because they do a lot of work. The problem is, it can be conflicted, especially when you work on development companies where there's not a lot of free trading stock, such that the brokerage firm or the bank you work for is not making money off the company because they're trading it. So when you can do a buy, sell, hold on a Newmont or a Barrick, that's great. People will trade it, and that's where you make your money. But when you would do a development play that's a liquid, what you're really banking on is doing a financing. So when you finance and you've got a hold on the stock, or, my God, a sell, there's no way the brokerage firm or the bank will get any piece of that pie. So, end of statement.
Okay. Perfect. Thank you. All right. Let's move on. It's a shame Scott had to take a plane to Europe, which is too bad, because what I wanted to get into now, and maybe Eira can help us on this. When a company's looking to make an acquisition, a real company, my sense is that probably 50 or more % of the 43-101 sanctioned 43 PEAs, pre-fees, and even fees are, let's just say, not up to snuff, or, to be honest, a lot of bullshit. Hey, is that what you find? And do you know that?
I mean, certainly the feedback we've had from corporates that have been in our data room, and we often would get complimented on the quality of our data and the way that we put our data sets together, and the overall quality of the work by our consultants. And I think what that speaks to is that there's a huge range of quality, in terms of the approach and in terms of who has actually been asked to provide those insights. And I think what we have to remember, I mean, it's really interesting, and I'm not saying that Camac is a cut above. What I'm saying is that we did our feasibility study at a time when the market was down. We had great availability of top talent in the industry. So we were able to hand select our consultants and really produce a quality product. When you're in a strong bull market, the junior companies don't often get the pick of the litter. They're all working for the senior companies, and you've got to make do, with the B or C or D team that you can get a hold of to do your feasibility study. And I think that does become problematic for potential acquirers in the future, because the work is not done to the same standard. So certainly for us, there's not many advantages to doing spending money in a tough market, but that was one.
That's certainly been my experience. I mean, Joe and I went through, I think it was 135 resource estimates for junior companies with gold, and really a dozen might have been projects that we would want to buy. And the issues that we find is that a lot of times the guy doing the resource estimate doesn't really understand the geology, and so they're smearing things. But as retail investors, we're sort of stuck with, well, that's, you get up and say, this is my PEA, I'm going to build this mine based on this PEA. But in reality, what was it you called these things? POSs? Yeah. The PEA is really a pretty optimistic study, a POS. That's Joe's, I like that term. Are there any questions out of the audience?
What's next for Eira?
Most excellent question.
I just want to answer that. I came up here. I'm going to offer her the job of CEO of Klondike Gold. I figure by tomorrow when it opens, Klondike Gold will double. That'll be great for our shareholders.
That would actually be a lot of fun, but we'll have to take that on a sidebar discussion. I honestly have not even thought for 1 minute what my next move is, and again, I really want to stress our plan was, to take this thing forward. So I think our whole team is a bit shell-shocked right now as we think about what the future holds for us. But we're excited that we'll be, footloose and fancy-free in a better market than where we were, a number of years ago when we all got involved. So we see lots of opportunity out there. But at this particular moment, I have absolutely no idea.
Besides going to St. Bart's.
Well, that would be good.
Any other questions out of the audience? No? There's got to be some. All right, let's look at what I've got here. Okay. This is good for you, both of you. What is it? I'll start with Peter. What is it that investors at shows like this, people who are not really inside the industry, what is the question that they should be asking and then they're not asking about what you're doing?
I would, having started at Prime, I guess, so like in the 90s working for Murray, and Murray flew me from the East Coast, and I held this twice a week meeting for brokers and investors to describe the Voisey Bay Rush, because we had 80 odd companies in it. At that point, I met all these people, and none of them had any idea about what was going on. And basically, I think from an investor point of view, it's come and meet the president, the CEO. It's exactly what this forum is designed for. And just ask questions, any questions. Listen to the person that you're thinking of investing in. Get a feel for it. You may not understand half or three-quarters of what he says, or her, but just get an idea of who the person is, how they seem to operate, what they describe the project to be, and try to get comfortable with it. I think that's probably the biggest general way to approach it.
I think that's excellent point. I was talking to Mike Halverson earlier. I was hoping he'd be here, but I asked him that same question, and he basically was like, "Am I comfortable with these people? Do I trust them? Are they quality people?" And I think that's so simple. And you can talk to these people here, and even if you, where's Mike?
Yeah.
So I'll see if he backs up what I said.
Just ask any company, what's the difference between talking to a retail audience versus talking to an institutional audience?
I'll throw that at Eira.
Well, and yeah, they're kind of, I guess my answer on the first question would almost be the same as the second, in the sense that, companies will sit here and talk about all the positive attributes of their project. That's what they want to convey. They want to talk to you about why you need to be invested in this asset. I think every investor should, be asking, what are the key risks? Every project has risks. What are the key risks, and how are you managing them? And, if you have any company that says, well, we have no risk, we're in a great jurisdiction, the logistics are perfect, we've got infrastructure, we've got, the asset is perfect, then I think that's when you really have to question whether or not you're hearing, the honest truth. And I think how a company manages risk is much more telling than, the risk itself. And I think for me, that's something as an investor I always look for. Understanding the risks and whether or not that company has really got a good hold on them.
That's a real good point. Ask somebody, a company, what worries you? What are your risks and how are you mitigating those? I think that's an excellent point. So let's get back to Mike. Mike's been extremely successful, and he knows a lot more about hunting and fishing than mining, but he's done really well. And why is that? What have you done right?
Well, first of all, I haven't done maybe as well as everybody thinks, but I'm still standing after this bear market. But especially when times are difficult, like we've gone through, I really think if I had to say one thing, you've got to really, really know the people behind it. And if you believe, hardworking, credible people that are not going to deviate from the job at hand, are going to cut where they have to, but keep the projects alive. And we've been through this, and the best of them are probably here. There's a whole bunch of others that aren't here. Oh, sorry about that. I'm shy. So I don't know if everybody heard that, but my comment was about during difficult times, you have to really know the people that you're backing, and you have to have confidence that they're going to do what it takes to get through the difficult periods of time. I have been successful, but I think my main if I had to pick one thing, is I've been fairly lucky or good in judging character, and that's worked for me.
Let's throw it over to.
Sorry about that. Still not hearing me.
No, that's a good point though. I guess
Yeah.
you might not be able to understand the geophysics and geology,
Oh,
but if you can just understand the person, that gets you halfway there, I think. And then but we all started over with rocks, didn't we? We're geologists, but we have to justify our existence, I guess. Would you add anything to Dave? Anything to add to that, Dave? Okay, so it's people, rocks. Is there anything else that you really think is critical that people miss?
Sorry. So you can't, and you and I have discussed this many times. There are two types of companies that are publicly traded anyways. Companies that use money to create wealth, and companies that already have an asset that spins off money and they give that money back to shareholders, or they use that money to buy other companies, and Nevsun is a perfect example. They gave some money back, and they preserved enough money that when it was an opportunity to help Reservoir buy a Freeport, they were there for it. And that's, I think, going to be a spectacular investment for them. So for companies that use money to create wealth, you need people who can execute, but you also need people who can convey to the audience a vision of what the future could be if they succeed. Because if you don't have that person, your cost of capital is higher. And in fact, in the case of many junior stocks, your cost of capital can be infinite. And it's very rare to have a company leader who can do both, and Eira's probably one of them. Peter, I don't know you that well, but you might be too. But you need to have that. And you and I talk about Tesla all the time. Elon uses $1 billion a year more than he produces, and yet has a $30 billion market cap, even though arithmetically or algebraically the company's worth nothing. But he's capable of portraying a vision of the future that allows people, or that makes people comfortable buying this stock for $200 a share. So the world of exploration and development works exactly the same way, and you really can't move forward in this business if you can't convey to shareholders what success looks like if all the cards fall in your favor. And they often need to, they don't always, but if you can't even convey to them what will happen if they do, then you probably won't succeed in this business.
Good point. That's the end of my questions, but I'd certainly like to throw it out here to the audience again. Joe, do you have any good ideas to throw out here? Huh? Yeah, good thoughts. Any input?
I mean, I guess one question I would have is in terms of how does, like, when you have institutional investors or strategic investors versus retail, do the strategic investors have a bit more inside knowledge of what's going on than the retail? Are the retail guys treated differently than the guys that are the 5 to the 10% and we talk about versus the guys that have 0.0001% of it, but make up 60% of your outstanding shares?
And for me, I can easily answer that. Absolutely, I have 4 billionaire shareholders that I know of, and no, they don't have any other access other than news releases and things. It's like, no, because I have a whole pile of small fractional shareholders left over from the rollback to more or less get rid of the old shareholder base and turn it into the new company. And some of them email and go, look, what's my share worth and whatever, and I still communicate. If you email the company, you get me, I email you back. And everybody deserves a response. You're a shareholder, period, and it doesn't matter who you are. I'll give this to Eira,
Anything
because
to
I'd
add
like
to
to hear
Eira?
her to say.
Listen, I think they're both very important. I mean, there's no question. I mean, you have to have, broad support, I think, for your story. I think the real opportunity, if you can, bring in some strategic investors that are larger shareholders. In my case, what that meant for me is that I had sponsorship in a tough market where my retail shareholders were already fully exposed. They hadn't any cash to deploy. If I tried to go to do a marketed deal, one, I probably would have failed to fill the whole subscription order. Two, it would have been at a much bigger discount. And three, it probably would have included a warrant, back to Brad's point about structure. So for me, having that sponsorship of the larger strategic shareholders was really about weathering the storm of a tough market, and they're completely aligned because they don't want to see a warrant because that dilutes their position. They've been in this since day one. They are aligned with management. They're aligned with other shareholders. What's good for them is good for all of us, and so I think if you can identify those types of sponsors and convince them that this is a good opportunity, it's an absolute win-win for all the shareholders.
You don't see a warrant as like a free financing?
Absolutely. There's nothing wrong with the warrant. I'm not saying that you shouldn't do warrant financings, but when you're really worried about blowing up your share structure and you know that you've got big ticket items coming down the line to get you to the finish line, to the point where you can sit down with the banks and talk to credit committees about debt financing, it plays very heavily into your overall strategy for financing. So obviously keeping the structure clean and really, limiting the amount of warrants that are overhanging the market so that you do get a response when results justify, it's helpful.
Okay.
Sorry, we did a piece about capital structure, and we talked about that. And what I appreciated what you said in January when you were at the Metal Investment Forum, and you were talking about you brought in a new CFO, you were looking at funding the project, you just finished the feasibility study, and now you're going forward, and you had lots of things that you wanted to do, and just last week or right before the M&A was announced, you basically said what you were doing for exploration. But what I'd like to understand is that you said outright that you wanted to avoid a stream. And so could you go through your thinking on capital structure if you went through to, like, Goldcorp didn't happen? Yeah. Where were you heading?
I think for us it's a much easier conversation because the capital requirements for coffee are only $317 million. And with where the stock has been trading recently, the ability for Camac to go out and raise $317 million, half in debt and half in equity, was not a big hurdle. Had we been trying to do that 3 years ago, it would have been a very different scenario, and we would have been probably looking very closely at a stream as a less dilutive option. But for me personally, and looking at the various projects I've been involved with over the last 5 years, if you have a strong conviction about the resource expansion potential of your project, and that the project that you've currently defined is not the limits of the upside, then I think it behooves all of management to look very carefully for other ways to finance that doesn't cap the upside for your investor. And so, I felt very strongly about that, and I was very thankful that by the time we did get through the feasibility study, this market had turned, and it was likely that we were going to be able to avoid all the bells and whistles that, and I appreciate companies necessarily had to go down that path in tougher markets, but those mechanisms often cap the upside, and that was something we really wanted to avoid.
Good point. Very good point. Are there any other questions out there? All right. Well, I think I'm going to call an end to this. I know you've got to get home. Thank you for sticking around. Personally, I think this was great. I think we're going to post this somewhere. I'm not sure where you can actually listen to it and hear what was going on. But this is great. I think it's come down to rocks, capital structure, people. I mean, it's obvious, but seeing it in real life, that's pretty good. So thank you all. I appreciate you coming to the show, and good luck, eh?